Dear investor, Edelweiss Private Wealth Management is pleased to present to you the latest issue of Investment Strategy Report for June 2018. Let's take a look at key highlights of May. Indian economy grew 7.7% in the fourth quarter, cementing its place as the fastest growing major economy, led by a strong rebound in the manufacturing sector. Real GDP growth clocked 6.8% in fiscal year 2017-2018. US pulled out of the Iran nuclear deal and has vowed to reintroduce sanctions on Iran, including sanctions on the sale of Iranian crude. This announcement, along with supply disruptions from Venezuela, led to a rally in crude prices during the month. Surge in crude prices and weakening currency have been the center of all macroeconomic discussions. Deterioration of currency account, led by rising oil prices, tepid exports growth, strengthening US dollar, and worsening terms of trade presents a substantial external risk. Fiscal deficit for 2017-2018 ended at 3.53% of GDP, broadly in line with the government's revised estimates. Trade deficit has widened by about $50 billion in financial year 18 and is likely to widen another $40 billion to $50 billion in financial year 19. Nifty posted a recovery this month to end flat after a sharp decline during the month post-Karnataka election results, where Congress and JDU formed the government. Index of industrial production grew 4.4% in March against a downward revised 7% increase in the previous month. In 2017-2018, IIP averaged 4.3% against 4.6% a year ago. In the current earnings season, Nifty earnings growth has been supported due to strong earnings by heavyweights, namely TCS, Reliance and HDFC Twins. We are likely to see earnings play catch-up and earnings multiple derating to take Nifty towards 17 times 1 year forward. The benchmark index may see some short-term correction even though the long-term growth levers remain intact. We maintain our Nifty target price for financial year 19 to 11,500. EPS estimates for Nifty index for financial year 19, financial year 20 and financial year 21 are Indian rupees 592, Indian rupees 702 and Indian rupees 781 respectively. As per blended estimates, index is currently trading at PE of approximately 17.5 times 1 year forward. We recommend investors to deploy 33% of fresh equity allocation, while the remaining can get invested over a 3 to 4 month period in a staggered manner. Clients having high exposure to mid and small cap via direct equities may look at trimming their positions and moving to large caps or managed solutions. The 10-year benchmark GSEC is hovering in the range of 7.58% to 7.91% on a semi-annualized basis. The bond yields have seen a rise in the last few weeks on account of a weakening rupee, rising international crude oil prices, and a rise in US Treasury yields. RBI conducted the open market operations purchase of government securities worth 10,000 crore on May 17, 2018. Further near-term open market operations purchase announcements may bring down the yields. Headline CPI inflation accelerated to a 3 million high of 4.6% year-on-year, belying our and street expectations of a 4.4% increase. The rise in CPI was predominantly due to unfavorable base effect and higher non-food inflation led by uptick in housing and service components of core inflation. We expect the MPC to maintain status quo in the June policy review, even though the policy stance might be hawkish in the backdrop of elevated crude prices and depreciating currency. We expect benchmark yields to remain volatile and trade in the range of 7.60% to 7.90% with an upward bias of 20 BPS. Yield movement hereon will depend on a host of domestic factors like inflation trajectory, supply-demand dynamics, and international factors like crude oil prices and global bond yield movement. We recommend investors to allocate 100% of their fresh fixed income allocation to long-dated buy and hold strategies and active accrual strategies with low to medium duration.